please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Taher Badshah, CIO-Equities at Invesco Mutual Fund, joining us on the Alpha Managers segment. Taher, hi, good afternoon. Story of this earnings season has been the reaction on Axis and today ICICI Bank. What's that telling you about the market?
So I think at some level, some of these corporate banks and their results were kind of important from this result season point of view, as well as going forward in terms of the moderation in the problem of the corporate banks and the eventual resolution of the NPA issue. And I think both these banks have therefore demonstrated, as we all know, we've all seen a fairly decent approach to the whole cleanup process, accelerated the cleanup process, and at the same time have maintained more or less their core banking franchise reasonably well. I think that's probably what we had kind of lined up as expectation in both these banks. We do own some of these, both these banks in some of our portfolios and funds. So to that extent, that was a core thesis that the core franchise is reasonably intact, and so they've been improving in terms of their loan mix and holding on to profitability reasonably well, improving CASA, and at the same time trying to accelerate the whole NPA resolution problem. So I think from that perspective, the market should cheer these two, and probably let's see how the public sector banks behave in the same regard. But I think that's a net positive for this quarter's result season and the overall mood of the market.
Okay, Taher, good afternoon. I'm going to talk to you about Jubilant FoodWorks. I don't know if you can talk about individual companies or stocks, but more to extrapolate this from the point of view of looking at how to value extremely richly valued consumption plays. Now, Jubilant has chosen to sell off almost 2% after what were phenomenal numbers. I don't know if you could find any fault with them or not. So what's the sense from here on, and what's the takeaway for consumption?
I think broadly consumption trends are improving in some cases like Jubilant Food, as you mentioned, and maybe a few others. There are certain base related issues which are far more, trying to magnify numbers substantially. So 26% SSG or whatever, probably I don't know whether that is sustainable, but it at least is reflective of the fact that underlying undercurrents in terms of consumer behavior, it's being seen in things like other consumer discretionary products, automobiles. It is probably seen in some of the other FMCG related pure FMCG plays as well, where we've seen volume growths trend reasonably well in this quarter. Anywhere between 8 and 10% are most of the where most of the numbers have been on volume growth. So I think it's reflective of improving sentiments and improving consumption patterns and stabilizing consumption patterns post hit on account of GST related issues and demonetization early last year. So I think that's what it at least seems to be telling us up until now, what we've seen of some of these consumer discretionary plays.
Okay, two more stocks which have made a lot of money for you. MRF, of course, has been an evergreen stock, and Exide as well. But again, Taher, on some of these stocks now at multi-year highs, you think the risk reward is still favorable? Auto ancillaries?
Oh yeah, I would think so, and especially some of the names that you mentioned. I think quite a number of these still our assessment is that they are reasonably inexpensive. They are not at blowout valuations, even though they've been steady performers over the last some time. But I think they've been ticking along fairly well in terms of their earnings delivery too. And the overall macro environment is kind of reasonably stable for them from the point of view of general automobile demand. Commodity prices for some of these names also remain quite benign to positive for them, and they are at valuations which are probably in line or maybe somewhat cheaper than the market as well. So we from a pure valuation standpoint and the growth which could be in the vicinity of around anywhere between 18 and 20% for these companies, I think they are not very expensive in our view, and they are reasonably attractive at this stage as well, despite some recent performance out of these names.
Okay. I was taking a look at the Contra fund, which is one of the biggest funds at Invesco, Taher. And there, obviously, financials and banks form the lion's share of your portfolio. Now, we've discussed some of the banks already. You hold companies like, Cholamandalam, Shriram Transport Finance. NBFCs, what do you like the most at the moment? Because at least most of the companies that have reported have actually come out with pretty decent growth numbers, right?
Yes, NBFCs, we've seen, you're right, that we've seen fairly decent numbers out of many of these names. And some of these we've owned for a fairly long period of time. In fact, we've seen them through a lot of distress as well. About 6 months ago and 9 months ago, some of these names were in a transition phase for one reason or the other. Either they had cyclical headwinds in their sector, or they were facing NPA-related issues, or they were trying to change their NPA recognition norms. All that was kind of impairing their bottom lines and operating earnings over the course of the last 3-4 quarters. So in a way, for us, these have kind of been more of recovery plays. But now they are kind of turning into growth at reasonable price stories after what we have seen of their performance in the last 1 or 2 quarters. So I think from the thesis that we follow in the Contra fund, these have kind of panned out reasonably well, that we buy them at times when they are in distress, or they have issues around them and they are cheap, and then hold on till the time they are growth at reasonable price, and as and when they become growth at unreasonable price, then look at exiting those.
Okay. After a long time, Taher, we have seen a trend where the decline in Maruti has not been strongly bought. It's off the lowest point, but still about 12-13% of its highs. Your thoughts on auto space as a whole, and the Maruti story, you believe it's still perfectly placed?
Yeah, I think, broadly growth trends in, like as I said, in the auto sector are fairly firm, and we have seen some of the, not just the quarterly numbers, but even the April sales trends. So they are looking reasonably good. They are probably, company-specific variations have been the case in the auto space even in the last couple of years, and probably will come about even in the future. Broadly, the trends are strong. There will be differentials in terms of the growth rates on account of different effects, maybe either on account of base or probably product mix or new launch calendar and so on. So from that perspective, there will be some who have seen a very strong tailwind on account of new product launches in the last 1 or 2 years. They might probably slow down at the margin in terms of growth. So what was maybe growing at 25% might grow at 15%, but it's not still a bad growth eventually. So I think, whereas there are some others which are actually been trending negative and starting to firm up. So for example, I was quite surprised to see that two-wheelers as an industry actually grew a fairly healthy 14% in fiscal 18, when there was not much of expectation out of that industry, whereas passenger cars actually grew only 4.5%. I mean, Maruti did very well, of course, but as an industry, it didn't grow as strongly. So that just maybe at some level throws up some interesting investment opportunities.
Okay. Taher, you also have holdings in a couple of big FMCG, big oil and gas names. Reliance is one of them. I think Petronet is a stock that features across several of the funds as well. So what is the call here? I mean, is it just gas you're looking to play?
No, I think it's absolutely bottom up. I mean, Petronet is a different story. It's obviously LNG is what the play is, and it's pretty straightforward from that perspective. Reliance is a combination of both the core business as well as what we see in terms of its ability to establish a reasonably decent footprint on the telecom business. So I think we don't really have a very large holding or significantly dispersed holding in oil and gas. We have a couple of names which we own in our portfolios, and they constitute, and since we only buy overweight positions, they add up to being a fairly decent number. But both these names that you mentioned are on their own individual merits, nothing which is kind of common to both these names. One is a volume story, the other is more about valuation stroke improving dynamics in one business, supported strongly by a very well-trending core business. So that is how the stock selection on both these names has been.
Okay, on metals, Taher, how should investors approach now? We had a clean 1-year run where stocks ran up 3x, 4x. From these levels, you reckon we are still in upcycle?
So among the frontline, pure commodity plays, be it base metals or non-ferrous, we don't really have any exposure right now. We have a couple of mid-cap stroke small cap commodity or commodity plus kind of companies is what I would call them, and they are predicated not as much on price movements or strength of the commodity price cycle. They are once again predicated on their own merits in terms of new products introduced or change in product mix or a substantial capacity expansion which will drive volume growth in the next 2 years. So some of the names that we own are basically from that perspective. So we are kind of right now not taking any playing any price call or a strong commodity cycle kind of play in our portfolios.
And finally,
on the metal side at least.
Finally, Taher, I was just looking at the screen and I saw Radico Khaitan. That brings me to my last question to you. You hold both United Breweries as well as United Spirits across different portfolios. I think the mid and small cap and the mid cap fund. Again, these stocks have had a phenomenal run last couple of months. Is there more to go? I mean, are you expecting better earnings as well as we go forward in the year?
Yeah, I think both these spaces are, from a volume trajectory, we all know that these are still reasonably long duration, volume growth plays. Once again, these are companies which we bought them at times when, there have been issues around them and they've been under distress and so on. So I think, as we stand today, we clearly are expecting earnings growth to improve over a period of time. Their profitability in both these businesses and both these companies are stabilized, and we are not expecting any great upside from margins, etc., from here on, but we would want to see the current profitability structure and margin structure stabilize. That's what we are looking for out of results. I think quarterly aberrations in terms of volume growth, these are also companies which have actually had a fairly decent amount of headwinds on account of regulatory issues. Those have sort of, if not entirely, abated to some degree, and that's also contributed to some part of their to their valuation expansion and performance of the stock prices. And I think they still remain like those stories where regulatory still is a headwind and gradually can convert into a tailwind.
Final question from my end on the oil marketing companies, where in the past you have had positive view. In the election year, you think that could be a bit of a negative story, or after the correction, is that a buy now?
They've kind of now become plays which are more of they'll operate in a very narrow band. You buy them when they are probably around book, or maybe sometimes maybe even book if at all. These are going to be kind of companies which will be more like utilities. I don't think there is now a re-rating play which is available here, and especially given the current headwinds both on oil as well as on politics, on government. So to that extent, we have to only play them for the fact that they are kind of 13 to 15% return on capital companies. Plus, some of these, or in fact, rather all of these, are actually going to embark on a reasonably strong capex program over the next 2-3 years, which was not the case in the last 2-3 years. And that will have its own dynamics at play in terms of its impact on return on capital as well as in terms of profitability, in terms of growth, earnings growth. So I think these are more like now utility plays. You buy them when they are really cheap, and probably if they are closer to 2x price to book or so, you kind of exit.
Taher, always a pleasure talking to you. Thanks very much for taking out the time and taking us through your approach to the market right now.